average Canadian spends more time picking up their Netflix subscription than they do in understanding their mortgage. And one costs $20 a month, and one can affect their financial future for the next 20 years. In today's video, I'll not only cover the basics of a mortgage, but I'll show you a clause in most mortgage commitments which costs people over $20,000 and they don't even realize it exists. And if you watch till the end, I'll also show you a payment trick which doesn't cost you anything out of pocket but can save you tens of thousands in interest. My goal today is whether you're a first-time home buyer or someone who's been nodding along mortgage conversations and not sure what to say or what to comment on that, or someone who really wants to understand what it takes to buy their home in Canada, I want to educate you, give you the basics of Canadian mortgages, and make sure at the end of this video, you are equipped to understand and make your mortgage decisions. My name is Raghav Manchanda. I'm a mortgage broker with 7 Lending, and I specialize in helping people make better mortgage decisions across Canada. So without further ado, let's jump straight to the content. Okay, so what actually is a mortgage? A mortgage is a loan secured against a property. The simplest way to understand is if you're buying a property for $1 million and you're putting $200,000 down, whatever is the remaining loan you get from a bank is called a mortgage. So in this case, if you're buying for $1 million, you put $200,000, $800,000 is the mortgage which is secured against the property. Now, it is really important to understand the simple line of secured against the property because everything we talk about much later will come back to this. The security of the lender is your property. So in a future event, if you default or for any other reason, they have to call the loan. Their security is by taking over the property or selling the property and recovering the money from the sale. Now, do you remember that 20,000 clause I was mentioning in the beginning of the video? I'll now jump straight to it. In Canada, there's 2 kinds of mortgages. There's an insured mortgage or a conventional mortgage. Simply put, insured mortgage is whenever you make less than 20% down payment. So whenever you do less than 20% down payment, you are required, it's not optional, to get a mortgage default insurance. In Canada, there are 3 companies which offer mortgage default insurance. There's CMHC, which is one of the biggest ones, there's Sagen, and then there's Canada Guarantee. Whatever mortgage amount there is, if you're putting less than 20% down, there's typically a 2.8 to 4% premium added on top of the mortgage amount onto your loan that you have to pay for, which basically does is secures the lender in case you default. Yes, you heard that right. This has no benefit to you. It just benefits the lender that in case of a default, they are covered by the mortgage default insurance company. Now, one of the good things about getting an insured mortgage is because they're insured, you do often get access to some of the lowest rates in the market, and typically insured rates are cheaper than conventional mortgages. Now, conventional mortgages are whenever you do 20% or more down payment towards your property, and in this circumstance, you are not required to get mortgage insurance. So that can save you a lot of money. So if we take an example that you're buying a townhouse in Langley, which is worth $750,000, and you're putting 10% down, which is $75,000, your mortgage amount will not be $675,000. It will be $675,000 plus an insurance premium of almost $21,000, which will be added to your mortgage amount and included in your monthly payments. So one of the most common questions I ask referencing on this is, what is the minimum down payment you have to make? Is it 5%? That's partially true. It's not 5% in all cases. So the minimum down payments are as follows. If you're buying a property with a value of up to $500,000, you can make 5% down. If you're buying a property worth $500,000 to $1.5 million, you pay 5% on the first $500,000 and 10% on the balance. So if you're buying a property worth 1.3, you'll pay 5% of the first $500,000, which is $25,000, and on the balance of $800,000, you will pay 10%, which is $80,000. So for a $1.3 million property, your total down payment required will be 80 plus 25, which is $105,000. And this is the minimum to get an insured mortgage. If you want to get into a conventional mortgage, you do have to make 20% down. One thing to also remember is you cannot do insured mortgages to buy rental properties. It is mostly for your primary home or your second homes. It does not cover a rental property. For that, you do need 20% or more down payment. Now, moving on to this, let's talk about rate. There are primarily two kinds of rates which exist in Canada. There's a fixed rate and a variable rate. A variable rate is when your rate increases or decreases with the Bank of Canada and the prime rate. So when the prime rate goes up, your interest rate goes up. When the prime rate goes down, your interest rate goes down. This topic entails a lot more than what I can cover in this video. So I have actually made a detailed guide on how to make this decision in 2026, and the link to that is in the description. With fixed rates, your rate is locked for the duration of your term. Once you put that in, whether you have a 5-year term or a 3-year term, your rates are locked, it stays as it is. One other difference between fixed and variable typically is fixed rates have a higher penalty to break than variable rates, which usually have a 3-month interest penalty. I've covered a lot more details on this in the video mentioned in the description. So next up, which confuses most people even now, is amortization and term. And yes, those two are separate things. And amortization is the total amount of time it will take to completely pay off the loan. The most common in Canada used to be 25 years, but now it is 30 years. Even for insured mortgages or conventional mortgages, 30 years is kind of the new standard, which changed a few years ago. Typically, the longer the amortization, the lower your monthly payment is, because you're now taking a longer time to pay off your mortgage. The downside of a longer amortization is that you do end up paying more interest because you're holding the mortgage for a longer period of time. A term is typically the length of time for which your terms are locked in, which means your rates, your offer, etc. The most common and default in Canada is 5 years. However, 1 and 3-year terms have become recently really common, because no one knows what's going to happen to the market in 1, 2, 3, or 5 years. So they want to bet for a shorter period of time, and that's what they want to hold themselves on. My general recommendation is, for amortization, go for the longest amortization. So if 30 years is available, take that. And whenever your budget allows, make bonus payments so you can pay off your mortgage early and save on interest. One thing to note, that for some alternative mortgage products or private mortgages, you can get 35-year amortization or interest-only loans, but of course they come with a premium, and that's not the focus of this video. Now let me talk to you about the trick I promised on how you can save tens of thousands of interest. Now, when it comes to payment, most people just go and sign up for monthly payments. Why? Because it's simple, that's what they understand, and that's the most common choice. But common is not always the best option. I want to talk to you about a smarter option: accelerated bi-weekly payments. So here's how it works. You take your monthly payment, you cut it in half, and you make that half payment every 2 weeks, which makes it 26 times a year. And you end up paying 13 months of payments instead of 12 months. So you're paying one extra payment every year. You know the great thing about this? On a typical mortgage, this can shave 2 to 3 years off your amortization and save you thousands of dollars in interest, just one extra payment every year. One thing to note, the accelerated biweekly is something you have to ask by name, because this is different than the standard biweekly payment, which just equals to 12 monthly payments a year, not the 13 payments option. So how do typically lenders decide whether you get approved or not? Well, there are 4 things, and I'm going to keep it really simple. The number one thing is your credit score. Credit score matters, and it does make a big difference, especially if you're doing less than 20% down. If you're doing less than 20% down for an insured mortgage, most lenders typically want you to have a minimum credit score of 680. They will not entertain, in 99.99% of the cases, if you're below that score. So make sure your credit score has active trade lines and you maintain the minimum credit score. One exception here is if you're a new to Canada program, you don't have established trade lines, there could be exceptions in getting the mortgages approved. We have worked on a lot of those scenarios. So next up is the down payment. Your down payment plays a very quintessential part of your mortgage approval. Whatever down payment you have, for most banks, They want to verify the source of it and also need a 90-day history of how you got the money. Yes, you can get money from your immediate family members, your savings, sale of assets, etc. And for any other scenarios, you need to talk to your mortgage broker. So number 3 is income. Income matters. And here is why. Because lenders don't just qualify you based on the mortgage rate you're getting and on your income. In Canada, they started doing something known as a stress test. Basically, it means is they will often contract you at 2% higher than your actual rate or the standard qualifying rate. And the reason for that is to give a margin in case of rates going up and down, and to make sure you're not overstretched, and to make sure you don't land up in financial trouble. Now, most people hate this, it reduces qualification, but trust me, I've seen in countless scenarios that long term, it takes care of you. It's better to be conservative than stretch yourself at max, because life happens, rates change, and there's so many things we don't have control over. Now, typically what a good rule of thumb is, if your income is 100,000, your mortgage qualification on the property you can buy for is probably going to be between 4.5 to 5 times the income. Please note, this is a rule of thumb. It's not accurate. If you have other liabilities, different things, this math won't work, but this is a common rule of thumb which most people use outside in the industry to do some quick math to see how much you qualify for. So number 4, one of the most important, is property. Well, the insured mortgages I talk about, they won't lend on any kind of property. Typically, the more complicated the property is, it's tough to finance it. So if you're buying a mixed-use property, a manufactured home, or a property with strata issues, they are difficult to finance because of these issues. What I recommend is make sure you check the property type or get it underwritten before you fall heads over heels in love with it. Because sometimes what makes sense to you is not how a bank sees it. If it's a tough to do property, sometimes they won't do it even if everything else in your file looks great. Now, one of the most important things I want to talk about is pre-approvals. And I can't stress the importance of this. I can't really tell you how important this is. The reason is because here's what a true pre-approval is. Someone gets your file before you make an offer, looks at your credit, looks at your income, looks at your down payment, reviews them like an underwriter would at the time of an actual offer, and tells you what you would qualify for, what are the documents you would need, and does it make sense. How does it help you is, number 1, it gives you your number, that this is your budget, you can't stretch over that, going over that might be a mistake. Number 2, it tells you issues which can happen in your file. Number 3, it checks your credit and tells you of any potential issues. You know how many times we've seen people try an online pre-approval calculator come to us forgetting that they have a $500 liability, which was not budgeted in their pre-approval letter, and now they've given an offer for more than what they can qualify for. So a key here is get a proper pre-approval letter from a mortgage broker who actually underwrites your file. Not one of those online bank ones, because they don't actually go through your documents. Be prepared and make sure you do it right. So one last thing before I let you go. Now, imagine your goal is to get the best pizza out there, and I love pizza. And let's say you walk into a Domino's or a Fresh Slice or any of the national franchises, right? When you go and ask there for the best pizza ever, they'll tell you their best pizza, which might be one of the best pizzas. But it might not be, the oven pizza or with those extra toppings or like certain things how you want it. And here's what I'm trying to tell you. When you go to a bank, the most bank will offer you is their product. Whether that is the best product for you or not is up for debate. When you work with a mortgage broker, we have access to banks, monolines, alternate lenders, credit unions, etc. We can go across the spectrum and tell you what is the best option out there. And there have been times when I've told someone, you know what, your best option is your bank, just shut up and take that rate. So make sure you talk to a broker who's qualified and gives you the honest answer, because you want to get what's best for you, not just what one person thinks is best based on the 4 options they have available with one lender. So if this video was of any value to you at all, make sure you drop a comment and make sure you're subscribed, and I'll try making more such videos. This is Raghav signing off. See you the next time.